All right, so in this video, we're going to go through a couple of different math concepts that will help prepare you for the final exam. The first concept I want to talk about is how we use cost of goods sold and the average inventory to calculate our inventory turnover rate. So if you recall from the lectures, our cost of goods sold, we start with our beginning inventory. So the amount of dollars that we actually calculated or we ended with the period before becomes the new beginning inventory for the new period. We add in all the purchases for that time period, and that gives us our total available inventory. That's the dollar amount that we have to produce all the food that we want to sell. Now, at the end of the period, food only becomes part of the food cost when it is put into production. So if we have anything left in inventory, we need to subtract that in order to calculate accurately the cost of goods sold. So let's do a quick example here. Let's say we're going to use the month of November. Okay, so November 2019. And we start with a beginning inventory of $2,000. Now we received orders on November 9th, November 16th, and November 25th. Okay. On the 9th, we received an order of 2,500. Now we get this information from all of our invoices that we receive. On the 16th, there was an invoice of 2,000, and on the 25th, we have an invoice of 3,500. Okay, so by adding all of these together, that tells us that our total available inventory for the month of November was $10,000. Okay, now at the end of the month, November 30th is finished. We go and do our physical inventory and we realize that there is still $1,000 worth of product in our inventory, in our storage. So for that, we're actually now going to subtract, which then tells us that we have $9,000 in our cost of goods sold, which means all the product that we sold cost us $9,000 to produce. Okay, so now let's take this a little bit further. Using some of the same information to calculate our average inventory, we take our beginning inventory plus our ending inventory, and then because we're working with two numbers, we divide by 2 to get our average. So in this case, our beginning inventory was $2,000. Our ending inventory was $1,000. We add those two together to get $3,000 and divide by 2, which gives us an average inventory of $1,500. Which means on average throughout the month, we had about $1,500 worth of product in our storage on average. Okay. Now we look at our inventory turnover. Our cost of goods sold was $9,000. That's how much it costs us to produce everything. And we divide that by our average inventory of $1,500. And we get a inventory turnover of 6, our rate of 6, which means we turned over our inventory 6 times throughout the month. Okay. And again, as we talked about in class, that number can be good, that number can be bad, depending on the situation. If you have a limited storage space, you're going to turn your inventory over a lot more. If you use a lot of already prepared products or things that have longer shelf lives, like canned goods or frozen products, your inventory turnover might be a little bit lower. If you're using fresher items, then your inventory turnover would be higher so that those products don't go bad. Okay, so again, we use our cost of goods sold to then plus our average inventory to calculate what our inventory turnover rate is for that period of time. Now, one more thing we want to use cost of goods sold for is our food cost percentage. Okay, so with our food cost percentage, remember, we have our handy little tool here, cost percent sales. And in this case, we are looking for what our monthly food cost percentage is. Okay, so if we're looking for our monthly food cost percentage, remember we use this tool, we cover up what we're looking for. We're covering up our percentage. And what's left over is our cost divided by our sales. Okay, and so if we remember, we go back and our food cost for the goods sold was $9,000. And if we go to our sales receipts, we can find out that our sales for that period of time was $30,000. Okay, so if our sales were $30,000 at that point, we divide 9,000 by 30,000 and we get 0.3, which then if we move that decimal place over 2, add the percent sign, we get 30%. Okay, so that means our food cost percentage was 30% for the month of November. And again, is that a good food cost percentage? Is it a bad one? Really depends on the context of the organization. Remember, we want to try to stay between a 30 to 33% food cost, and if we can lower that while still maintaining quality, then we can increase potentially our profits by controlling that food cost percentage. So again, this is how we use that cost of goods sold formula for multiple different applications. All right, so with the next concept is our profit and loss statements, or P&L statements. This is a quick snapshot of how our business is doing, whether we're operating at a profit or a loss, and then in the other budgets, that's where all the details are going to be found. But in this case, we're just going to look at this quick snapshot. And in the budgeting process, we can also just look at just assigning percentage values to begin with as our goals to reach, and then take those percentages, apply them to our projected sales dollar amount, and that will give us the actual dollar amounts as far as how much money we have to spend on food and beverage, how much money we have to spend on labor, and etc. Okay, so if you'll recall that our sales is 100%. Okay, so as a percentage, everything else from here is going to get subtracted from our sales. Okay, and then what's left over is either going to be a profit or a loss. Of course, we want to operate as a profit. And so let's say we have a 33% food cost, and then we have a 35% labor cost, and let's say we have a 20% other expenses. These numbers right here add up to 88%. So remaining from that, our profit is going to be a 12% profit. Okay, this is our goal. We can basically take all these numbers and then subtract from 100 to get what that missing piece, in this case, that missing piece was the profit. This is a very simplistic view of this P&L. So now let's use it as an actual example. Okay, so remember, our sales is 100%, which means we're going to fill in the pieces of the puzzle. So our labor expense, 35%. Our other expenses, 23%. And our profit is budgeted at 10% of our sales. Okay. So now, the first piece of the puzzle, because we're asking, the question is, what is the menu selling price? That is the main question for this particular topic. So let's kind of just circle that. What is the menu selling price for the hamburger? we need two pieces of the puzzle. So if we look at our triangle, cost, percent, sales, or menu price, if we cover up what we're looking for, our menu price, what's left is our cost and our percent. Well, we have our cost. Our cost right here is $4, but we're missing our percentage. With the information that's given, we have these three pieces of the puzzle. We need this fourth piece, our food and beverage cost, okay? So if we add everything up, we've got 35 plus 23 is 58, plus 10 is 68, so these are 68%. If we know that our sales is 100, we can now simply subtract and get a food cost percentage of 32%. We see how that works? So essentially we've given you three pieces of the four-piece puzzle. You've got to figure out this fourth piece, and now we're going to apply it to our formula. Remember, we're going to divide by 0.32, convert it back to a decimal by moving that decimal over two spaces to the left, remove that percentage, and we get $4 divided by 0.32. And when we do our calculations, we end up with a menu selling price of $12.50. $12.50 is our menu price for that hamburger. Taking all those costs from that standardized recipe and applying that food cost percentage, that average food cost percentage, and we get $12.50. All right, the next one I want to talk about is our conversion factors. So remember, as we're trying to prep for different meal periods, if we just want to double our recipe, we can just multiply everything by 2. That would be a conversion factor of 2. So for example, to figure that out, let's say that we need 30 portions, and our recipe yields 15 portions. Okay, that's 30 divided by 15. Our conversion factor is 2. So essentially we're going to double the recipe. But oftentimes it's not as simple and not as even as that. So let's try another example. Okay, so now let's say we need 55 servings prepped for lunch, and our recipe makes 12 servings. Well, we can take 55 divided by our 12 servings that our recipe makes, and we need our conversion factor of 4.58. Okay, so that's what we're going to use to multiply by if we need 10 pounds of flour, or if whatever we're working with. We're going to use this conversion factor to multiply the amounts of the original recipe, that in the end, our 12 serving recipe will actually yield 55 servings. Okay, it can actually go the other direction too. So let's do an example that way. Let's say we only need 20 servings. But our original recipe is actually going to make, let's say, 40 servings. So 20 divided by 40 gives us 0.5. So you can tell by the number of the conversion factor if you're increasing the number of servings that you're going to make from the original or decreasing the number of servings. If it's less than 1, that means you're decreasing from the original recipe. If it's greater than 1, you're increasing from the original recipe. Okay. Let's look at exceeding our projected costs. So in the budget process, of course, we cost out a recipe. And we know that we take that recipe, it's going to cost us this much, this is the serving size, and this is the yield, the number of servings we will get out of each recipe that we make. However, if we do not practice good portion control and we serve more, then we're going to exceed those projected costs and we're not going to be able to serve as much. Okay. So let's go through this problem here. The standard portion size of roasted pork loin is 10 ounces, and the current edible portion cost is 40 cents an ounce. Okay. If the kitchen staff slices 12-ounce portions and the restaurant sells 200 orders during the week, by how much did the food cost exceed the standard? Okay, and so what we can do is we can look, and what our original serving size is 10 ounces, but we actually served 12 ounces. So that means we went over by 2 ounces. If each edible portion cost is 40 cents an ounce, we take our two ounces that we served over, our 40 cents per ounce, and essentially we went over by 80 cents per serving each time we sold our pork loin. Now that 80, because we sold 200, now our 80 cents per serving that we went over is a total of $160. We went over by $160 than what we should have sold based on our standardized recipe or standardized serving. Okay, so this is important. If this is, let's say, on a daily basis or on a monthly basis, 160 times 12 months out of the year, that's an extra almost $2,000. If it's on a daily basis, we did 160 and we're open 360 days a year, that's almost $58,000. Okay, and so you think, oh, well, serving 2 ounces over may not be a huge deal, but it adds up over time. So as we're looking at this type of a problem, what we want to know is how much did the food costs exceed the standard? Okay, so what we can do is we can look at that variance. Again, the variance is the difference. So what should we have sold versus what we actually sold? Okay, and so in this case, just to review, we went 2 ounces over. And so at 40 cents an ounce, that's 80 cents per serving times the 200 servings that we served, and that's $160 over. All right, now projecting our labor hours. We've talked about in class, how many times you've heard your manager say, I'm over my labor budget. I have no more dollars in labor budget. But as we're trying to figure out how many hours we have available to spend, or how many hours we have available to schedule, we're going to look at the dollar amount. So, we're budgeted to have $15,000 in labor costs, okay? And this is important because, our payroll includes our labor, it includes our benefits, and our hourly waged paid employees, okay? And so if our total, we're looking for the number of hours available to schedule. And so now we're talking about our hourly people. We're not talking about our salary people, because remember, they're going to get paid the same whether we have 10 people that walk in the door or whether we have 100 people walk in the door. So our hourly people are the ones that are going to change and fluctuate based on the volume of business. So we're going to start with our $15,000. That is our total budget available. Now our fixed payroll dollars is our salary. We're going to subtract that because, again, it does not matter if we are crazy busy or if we are completely dead. We're going to spend that $4,000. It's a fixed cost, okay? And so we subtract that and we get $11,000. Now our server payroll dollars is $1,000. Okay, so you remember servers are like $2.13 an hour. So we have our payroll for servers, and which means we have a remaining $10,000 to spend on cashiers, hosts, bussers, and kitchen staff. Okay. If each staff member, just to kind of keep it simple and easy for this math problem, we now have $10,000 available, and each person gets paid $10 an hour. Okay, so if we simply just knock off a zero, because we've got 1 0 here, that means we actually have 1,000 hours to schedule between these 1, 2, 3, 4 different positions, these 4 different departments in the restaurant. Okay, so that's how we go from our dollar amount we have available to actually calculating a number of hours that are available. And you can change these numbers up, and you can practice a couple of different methods. The last one I want to talk about is our cost of turnover. In class, we talked about how turnover is traditionally pretty high in our industry. And so anything we can do to alleviate or to prevent that turnover is something that's going to be very beneficial and very cost saving for us. And so let's look at this problem for a moment, and then let's kind of dissect it. So a manager reduces the turnover rate from 125% to 100%. If the restaurant has 120 employees and a new hire costs an average of $200 to recruit, hire, and train, how much money did the manager save the restaurant with the lower turnover rate? Okay, and so what we're looking for is a dollar amount. How much money did we save? So now let's talk about what the manager actually did. So the manager decreased our turnover rate from 125% to 100%. So we take 125 was our previous, we subtract what we went to, and the difference is 25%. Okay, so that's our 25% difference, which means we saved 25% on our turnover. So what we can do now is 120 employees times 0.25 gives us 30 employees. Okay, so which means we decreased our turnover rate by 30 employees during this particular period. And now we've got our 30 employees, and let's switch to green for money. We've got $200 to recruit, hire, and train each person. So now if we multiply this 30 times our $200 per person, that's a savings of $6,000. That $6,000 can go to capital improvements. It can go to bonuses. It can go to profit for the investors and the business owners. So you can see how by decreasing our turnover rate, we lessen the actual amount of money spent to recruit, hire, and train and replace those people that leave. I mean, that $6,000 can even go to retaining different employees throughout the year, different incentive programs to keep your employees engaged, and you maybe have some competitions to keep the guest service and customer service at a high level, and to motivate your employees to be part of the team and the overall success of the business. There's lots of different ways that we can do that and utilize that $6,000. But essentially, we're going to take what the difference of our turnover rate is, apply that to the number of employees we have, so multiply that percentage that we saved, and then that's going to tell us that we save, because we decreased from 125 to 100, we're saving money. If we had increased our percentage, then that means we would have gone $6,000. We would have spent more recruiting, hiring, and training our employees. So because we went from 125 to 100, we saved. If we had gone the opposite direction, that means we would have spent $6,000. So I hope this helps. Review these different concepts, review the additional online review that was in the announcement in Canvas, and this will help you prepare for the final exam.